Hello, everyone. Thanks for joining us. And we have a good a good turnout of people. And I think that's obviously because we have a lot of news. Um, Please note I'm wearing blue, the blue shirt, the blue tie. It's where to begin. The I have a lot of thoughts, and a lot of them are short-term positive, long-term negative. And what I want to say is that um, this is, I think, a realignment, as we're saying, that it is a severe change. It is a structural change. And I'm going to share some commentary on from Cetera. One of the things that happened before the election is we had a lot of people saying, should we get out of the market? Should we, what do you think? Is the market going to tank? And I was consistent in saying no, that I would stay in the market, maybe wait if you've got new money on the sidelines, if you're, it's going to drive you crazy. However, we were correct. I thought the market might have a relief rally. I certainly thought if Trump got in, which I wasn't expecting exactly, I thought it was 50-50, maybe leaning towards Kamala, like towards the end. But then I thought that the market, like last time when Trump got in, likes tax cuts. The market likes spending and deregulation. So that's, I think, why we had a big run up in the stock market yesterday. Now, the one thing, and I deplore the media's coverage on so many things, including this, there are many markets, including bond markets, and that is the market that we need to focus on, as well as the stock market. The bond market is a reflection. I'm talking about the 10-year treasuries, which is basically a reflection on the economic health. And that went the opposite direction yesterday. And so I'm going to focus on that because I don't know why it's like it's too complicated, maybe for the media to talk about or to pay attention, but it can be simplified. We saw a spike in mortgage rates, and this is the opposite of what people are thinking. Many of the policies and also increasing things like mortgage rates and interest rates are inflationary, and tariffs are incredibly inflationary. They are a direct tax that we pay. Often people think that, oh, the tariffs are something that against China or against a foreign country. Yes, it can affect their ability to sell their products in the United States because of the tariffs, because they become expensive. But if you have a 100% tariff on something, a product that you paid $5 for, now it's $10. I mean, that's a simplification, but that's inflationary. So that's an issue. This is Cetera investment commentary. It's short. It hits on some key points, and I typically always agree with this. It's not just because we're with Cetera, but I think it's well argued, well written, well put together. A new chapter. I agree with that. We are in for a new chapter in American history. A new chapter, economic implications of Trump's second term. The risk of a contested election is eliminated with Trump victory. I'm going to make a comment there, and of course, I have a big mouth, and I'm going to use it. The risk of a contested election, unless it was something like Gore versus Bush, where you've just got a few votes that could go either way that have to be counted, the risk of a contested election was one-sided. The Even now, it's like as all of a sudden, despite all of the charges that the election is rigged, the fake, all this fraud that was being accused, the Trump campaign was absolutely trying to prepare for a contested election. And now that they've won, all of a sudden, oh no, everything is legitimate. There's no fraud. There is no, so the hypocrisy is just monumental. So this is another failure, I think, of the media and how they've covered this more moral equivalence. But the risk of a contested election is eliminated now because the Democrats are not going to spread lies like they do. Bond yields, this is the next major point. Bond yields and stocks are rising as investors react to a Trump second term. Investors should curb their optimism or pessimism and stay focused on their investment goals. We've been saying that all along, and I really want to emphasize this. I think that the economy is strong. It has been resilient. We have had good economic growth, good inflation numbers coming way down. We are having pretty good unemployment numbers. And because there has been some slowing down, this is a key point. The Fed has started to cut interest rates. I'm going to focus on this right now. We had a 0.5%, 50 basis point cut last month. And today they are supposed to announce another cut. We're expecting a quarter point. I think that's baked in. However, there are a lot of economists right now today saying this is a mistake. They should not cut rates today. The Fed does not like to give surprises. They actually almost give hints, Fed speak, as to what to expect. And I think that we will have a quarter point cut. Now, again, next month, we were thinking we might get a quarter point cut. Things are so inflationary with some of these projections and the interest rates, the market's reaction, that it may be destructive to and against the Fed's inflation targets to continue to cut interest rates. You cut the interest rates, you stimulate the economy, that stimulates inflation. So you have to be really careful with this. So this is a big issue. I'm going to go into this in a second. Um, the uh, they talk about we understand elections can be very emotional and polarizing, but we remain focused on the economic and investment implications. You do have to take the emotions out of the buy and sell decisions. We use money managers who are absolutely, they say no emotion. We look at market trends. We do not fight the trends. The market is up. We're going to stay invested. And even if they get out, it's not emotional. It's typically there are trends that we are worried about. And so we're going to reduce risk. I want to emphasize this is going to be key next year and maybe in 2026. If you are close to retirement or in retirement, you want to focus on controlling risk. Take advantage of the growth now, but I think that the potential for enormous is absolutely off the charts. The potential for risk is the highest we've had in many years, I think. Trump campaigned on themes focused on the economy, including tariffs, immigration, and tax policies. Specific details on these initiatives and priorities will emerge as we near Inauguration Day in January 20th, assuming the Democrats don't try to stage a coup on January 6th. That's a joke. This goes through compliance. It's going to be interesting to see, but nobody's going to muzzle me. To the extent to which tariffs are implemented, the level of immigration limits and the magnitude of the changes to our tax policy are uncertain, but the likelihood is high. It is absolutely very likely that we are going to have significant changes. And life has changed. We have to get used to these changes. And so we'll see what they are. I've already heard people who have supported Trump and some Republicans backtrack. Oh, it's not going to be like he says. Some of this is drama. Some of this is campaign. Some of it's like bluffing, which there's no reason to believe that. In fact, I think there's every reason to believe the opposite. He got a majority of the votes, not just electoral votes. And it looks like there may possibly be unified government in both houses, the Senate and the House, which happened in his first term. So right away. So also there's no excuses then for them failing to do what they're promising to do if they have a majority. There are still some things that require a supermajority. And if it's a fragile majority, as we saw before, sometimes not every Republican goes along with something. So there is a risk of these, reducing immigration or rounding up millions of undocumented or illegal people is inflationary. It puts huge pressure on wages. There are not enough workers. If there are not enough workers, or if you have to pay these workers more, food prices, for example, chicken processing plants, meat processing, it just becomes more expensive. This is the opposite of what a lot of people wanted when they voted for him. We'll see where it goes. It's, time will tell. So however, even if we do see a boost in inflationary pressures, which is predicted, it may not materialize until 2026. In Donald Trump's first term, tariffs and tax reform were also major policy initiatives, but we never saw an inflationary spike. Now, of course, we had the pandemic and the enormous government spending, which also continued under the Biden administration. I think that's what caused so much of the inflation. This time, inflationary risk might be higher as service inflation remains elevated relative to pre pandemic levels, and the size and scope of new tariffs could be larger. Are very few restraints on the president imposing tariffs. Sometimes people say, oh, this has to pass Congress. It does not. Generally speaking, the president has a wide ability, power to impose tariffs. So that's another where I hear people backtracking. Oh, there's checks and balances. I think he will be, especially with basically a mandate, that he will be even more unrestrained, and that this is going to be an issue for those of us who are more traditional. And I'm like old school. So there, I think, are going to be a lot of daily outrages in terms of towards the end of the campaign, vulgarity, childish insults. I think appointing lackeys and people of just no competence, no credibility. You know, it's like Kennedy on vaccines. Like he says, I'm not going to take away anybody's vaccines. It's like it's like a dog chasing a car and you get it. It's like, be careful what you wish for, you may get it. So I think it's going to be, there is a small chance, in my view, things could go relatively well. But there's no reason to expect that, in my view. I think we're going to see a lot of societal dysfunction, and it's going to cause a lot of problems in the long run. And on a personal note, the there's this great expression that's like, we don't see the world as it is, we see the world as we are. And a lot of my opinions and my understanding and take on all of this is age related. I'm turning 65 next year, Medicare. And so it's like, I remember the United States, how it was. And it was not like this. That people were like more focused on, like John F. Kennedy said, ask not what your country can do for you, but what you can do for your country. And now people are like, what's the government going to do for me? And it's, my take on this is very different. Full disclosure, I am very proud of myself for eating my own cooking. I have said I'm using these money managers, the same ones I'm recommending. I'm using this particular annuity, and I'm not supposed to, I think, mention company names, but so I have it. I recommend it. I said, downsize, simplify when you get close to retirement or in retirement. We did it last year. We sold our house. A huge old expensive house. We bought and paid cash for another one. And I think everybody should look at what's in their best interest, the fiduciary rule. And it's like, if you think it's in your best interest to move on, get out of the country, have a plan B. If you feel threatened, if this is just not what you want for your life, then fix it, take control. If you think, well, I'm just going to wait it out and focus on what I can control and try to be positive about it, not watch too much news, great. The Federal Reserve, this is the Cetera investment commentary. The Federal Reserve may not cut interest rates as much as expected if they see signs of inflation reigniting. Boom, there it is. You thought you might see inflation go down. You voted this way because of inflation. Might not work out the way you think. We may still see high interest rates. Mortgage rates have gone up. Mortgage rates, I mean, yesterday, mortgage rates may touch 8%, and things get more expensive. This also increases inflation, makes things more expensive. So here, the early market reaction is likely twofold. First, markets are pricing out the possibility of a contested election, and we have the rising stock market. While bond yields are likely rising partially due to this relief rally, they are also rising around the possibility of higher inflation and higher than expected rates in the future. We're already seeing this. Bond yields surged after the election, and the strong likelihood of deficits remaining high also adds upward pressure to bond yields. That also increases the cost of the federal debt and servicing the debt. So if anybody is thinking this is conservative in the traditional, like fiscal responsible way, it is not. And no economist, no serious economist is pretending otherwise. Again, we'll see where it goes. Here's some words of wisdom also from Satara. Investors are digesting the election outcome and potential implications. How it all plays out over the next presidential term is uncertain. It is important to remember the US economy is $29 trillion in size. Our debt is getting there or more. And our labor force employs nearly 160 million people. The 500 large cap corporations in the S&P 500 generate 40% of their revenue outside of the United States. Quick comment on that. The value of the dollar is going up, which makes our exports more expensive. And we have international effects here. The United States has actually been leading the other global economies, other economies, in growth. And I still expect that to continue. Here is Let's see, that US corporations have shown resiliency over time as they adapt to policy changes. The data backs this up. In the 19 post-World War II four-year presidential cycles, the S&P 500 posted positive returns 17 times, 17 out of 19 times, with an average annualized return of 11.9%. Returns have been strong under both political parties. This is true. And again, it's about the underlying economy. I always hesitate a little bit to compare when you've got like a realignment with some of these historic figures. So here, the best words of wisdom: it's important to stay focused on your own financial goals and avoid being too bullish or pessimistic based on political views. There are broader economic forces at play than who is president of the United States. As always, consult your financial professional for guidance during these times. And I will absolutely tell people, and this is our job: stay invested, take advantage when the market's up. And we will also say, well, this is a cause for concern, time to get out. We monitor the money managers. Most of our money managers that we're working with, not all of them, will reduce risk if the market goes down. And that's what we want. Some do it better than others. Depends on the time over a cycle. Some do it better, maybe avoiding a downside. Some do better capturing upside. And we'd like to blend them for that reason. And I am the biggest believer in that more than ever now. We haven't had the uncertainty start, but I think we will. One other thing, I don't want to go on too long, but I want to emphasize the bond market, because you're not going to get is not unless you go to the business media or until there's a crisis. I don't think you're going to see this in the front pages of most of the mainstream media. Longer dated U.S. bonds surge. This is from Reuters. This is from yesterday. The Trump win is seen as widening deficits. The deficits would have gone up either way, but probably twice as much under the Trump proposals. The U.S. yield curve hits its steepest since late September. And now, of course, the focus shifts to today's Fed meeting. And so the yield curve refers to the difference between the short-term rates and the long-term rates. And when you are compensated more for the short term than the long term, that often is a forecast of a recession. That you are those are the things that we look at. And a couple other things on that. And I'm going to be paying really close attention to this over the next few years. Interest payments on the federal government debt are projected to reach $892 billion in 2024. This is more than the government is projected to spend on defense. And today, Mitch McConnell said one of their priorities is to increase defense spending. So we are definitely going to see an increase in spending. We are going to, although Elon Musk said we're going to cut $2 trillion, and he also mentioned clearly this has to affect Social Security and Medicare. We'll see where that goes. But so here, the federal debt the interest on the federal debt. This is more than the government spends on defense and almost a third higher than what the US spent on debt interest payments last year. A third higher. This increase reflects the combination of the rise in US government debt and higher interest rates. And listen to this. And even though interest rates are expected to inch lower in the coming years as inflation subsides, not so fast, the Congressional Budget Office forecasts that interest payments as a percent of GDP will continue to rise. The extent of this increase was not foreseen even in the past few years. The CBO's projections of the interest burden of the debt have been steadily increasing. So here we were thinking, yes, it's going to go up, but not maybe be so bad. Now we think it's going to go up and be even worse. Servicing the federal debt has been taking up an increasingly larger share of government spending. Interest payments made up about 13% of the federal spending in 2024, being the third highest category of spending ahead of defense, Medicare, and income security programs. This is a sharp increase from 2017 when net interest payments made up closer to only 7%. So we're getting near doubling in the few short years. Projections of the interest burden of the debt have increased dramatically over the past 4 years. The CBO, which is nonpartisan, currently projects that interest payments on the debt will be more than 16% of federal spending in 2034. So this spending crowds out spending on other things, and it is inflationary. And if interest rates go up, and it creates a cycle of failure. And we've seen this in other countries. Here I talk about Argentina, and we had this. We had the banks were forced to buy Argentine government bonds, became worthless. The banks closed, total collapse. Of course, I'm not projecting that, but sooner or later, regardless of who is president, what party, the chickens can come home to roost on some of these issues, like the deficit. And one of my concerns, I remember under Biden last year, was the debt ceiling debate, that game of chicken when, oh, are we going to raise the debt ceiling? If you do not raise the debt ceiling, you're talking about not paying your bills. This is debt that's already been incurred. So if you default, and that's never happened before, I'm not expecting it to happen again, or to happen at this time. But these are the calamitous things that could actually be out there if we get into a problem. And again, it could be years down the road, but it's if we get into this cycle of just increasing debt and higher interest rates, higher inflation, it gets harder to get out of. Here is a question or a statement. I'd like your response. Although I am very liberal politically with a strong sense of social justice from the standpoint of my investments, I feel that his desire to enrich himself and his billionaire supporters will help even little guys like me. Yesterday was an example, the market going up. And I do like the idea of people not projecting necessarily their own like social goals on the market. So it is absolutely possible that those who are invested in the markets the stock market can profit. I always mention there can be a big difference between Wall Street and Main Street. We saw that during the pandemic, super high unemployment, and businesses closing down, and then the stock market soaring because of all the government spending. So there can absolutely be a separation here. One of the things, though, I see happening is just like Russia, you have oligarchs in the United States. And there's no question that Jeff Bezos, who's tweeted apparently only twice in the past many years, both times to congratulate Trump on his election victories. And they are influencing the elections, spending a ton of money, and like Bezos, telling the Washington Post, you will not make an endorsement just days before the election. So some of these things are problematic. Will the little guy eventually benefit from these things? And I think the policies will favor the wealthy. They have been, and they will continue to do so. So I think that the wealthy with this will get better off, And also the tax cuts, we saw that favor the wealthy. Everybody else may continue to struggle, especially if there are things like inflation. That affects obviously the little guy more than wealthier people. How do money markets look for next year? Yeah, again, when we say money markets, we're typically referring to fixed income. I'm not sure if that's what this attendee is asking about. So the money markets would be like money market funds in the bank, interest rates. And we right now are thinking interest rates are going to still be competitive and high. We may see some rates go down, but certainly much slower. So that's the forecast. Those forecasts change a lot, though, based on economic conditions. I mean, we were not expecting to have those huge interest rate increases so far, so fast, and then we got them. And then we even look back and say the Fed should have done that faster or earlier, at least, to control inflation. So right now, we think we'll still have good rates for people who want money safe and in the bank. I think rates will still be, pretty good. It is possible, though, that the stock market should return even more. And the real issue, I think, is the bond rates, and that's going to affect people who are borrowing money. That rates on mortgages, car loans, those rates can go up, and of course, inflation. It would be really interesting to see whether or not inflation starts to go up. There are an amazing number of services that are available. And for example, you not only just relocation services, but there are like accounting firms that specialize in expat taxes. There are all sorts of organizations that are educating people about different places. There's International Living Magazine. There is the like money transfer services. So there are definite ways to do, and I've seen people, doing this, looking at, Portugal with the golden visa, and that's been closed. People who have ties to like Spain, like Luis, my husband, he's eligible for Spanish citizenship. That's in process. He's done all that paperwork, and I know several other people are doing it and have done it actually. But of course, you can do it without having ties. People are looking to move to Mexico, Panama, Costa Rica, and other places in Europe. One couple in Thailand. So and you have a lot of younger people who are looking to work abroad, maybe large international companies, move abroad, teach English. So there's a lot of opportunities. One of the things, if you're serious about this, you can do it. It's a question of figuring it out, doing the homework, learning it, and there's a lot of opportunity out there. And so we can try to provide resources again for people to look at if that they want to do that. So this is a great question on Social Security, and this would be another like quote unquote realignment. I'm planning to start Social Security within 3 years. Are there concerns? I would not think before that there are concerns. And Trump, to his credit, in my point of view, has said we're not going to touch Social Security, which is not what a lot of other libertarian or more those kinds of conservatives, they want less government. They want to cut this back. It's too expensive. We can't afford it. And there's some truth to that because the structural population, especially if you get rid of immigration, we need people to pay into the system to support the people who have benefits coming because of the population shifts. And so I do not believe that people who are close to Social Security have anything to worry about right now. But something does have to happen, or we will not be able to pay all of the benefits that are due. I think in 2034, then benefits will go down to like 74%. That changes every year as we look at the numbers. That means you either have to cut benefits or increase taxes. And you could easily increase taxes by taking away or increasing the taxable cap on earnings so that people who make more pay more into Social Security. Right now it's capped. Or you tweak the benefits. But to answer the question, at this point, I don't think it is, I think it's wasted energy to worry about that. There are other things to worry about, but it's something to pay attention to. Are there proposals? And there has to be at some point a proposal to solve the problem that is coming in 10 years. So then we pay attention to see what they're going to do. But I think it's very unlikely people who are receiving benefits are going to lose those benefits. Someone turning 62 in 2024 to take Social Security, and the answer is no. Generally speaking, we would look at your individual situation, but if you take it at 62, it's permanently lower. And especially if you continue to work, there's an earnings test, which means the following year, the Social Security Administration will start to withhold money from your Social Security for every dollar you make above a certain amount. And there's a formula for that called the earnings test. That's if you take Social Security and continue to work, you take it before your full retirement age. Anybody born 1960 or later, your full retirement age is 67. Generally, your best bet is to postpone it to a certain extent, continue working if possible. We look at your own personal situation. The only real reason I can see this is if you are not going to continue to work, you really need the money, or you have health issues and you think you have a shortened life expectancy. But we can review that. But the general answer is no. The longer you wait, the better for to take Social Security. So I am motivated, on fire. I'm going to work as hard as ever. And we are here. I am here. And I think we're going to have a wild ride over these 4 years. And there's always a lot of opportunity. And I think there will be enormous opportunity. So we're going to fight the good fight, do the right thing, try to grow money, make it safe, and make sure everybody is well positioned for whatever may come.